it was the FDIC sort of going after unwanted industries and using the banking system, right, to do that. If you shut off someone's access to their bank accounts, you essentially kill a company. And so these are direct quotes at the time. So this was the former chairman of the FDIC, 2014, scathing opinion piece in the Wall Street Journal. He wrote, "Don't like an industry, send a message to its bankers."
When we look at global market index, Germany's stock index is at an all-time high. India's stock market is at an all-time high. So everybody who thought that because of the increase in US interest rates, we're going to see massive downfall in valuation of emerging asset class or risky asset class, they all have been proved to be wrong as we're approaching the end of the year now. So it's a crazy year. Welcome back, Michael. After Christmas, we're coming back again for episode 6 of the Rundown. How have you been? How was your Christmas?
It's great to be back. Had an awesome Christmas. Got to see a lot of family. I have a huge family. So my mom's one of 10 children. So we all get together around the holidays and had an awesome time. But yeah, it's good to be back. How was your holiday?
It was amazing as well. And welcome everyone to another episode of the Rundown with Shiv and Mike. Hope all of you had great holiday period, celebrated Christmas with your family. And it's good that you're now back for another episode of The Rundown. This is going to be our last episode for this year, 2023. And we've got a lot in store for you. I know, Michael, you have come up with a lot of your crystal ball prediction from the archive also that you're going to share with us. We're going to talk a lot about what's happening in Solana, DeFi ecosystem, Fed, and just we're going to do another Formula One Grand Prix style fast recap of what this year was all about. So yeah, I'm excited for this, the end of year 2023 recap episode on the Rundown.
I think it's a great opportunity to kind of sit back as we head into the new year. Let's just take a look back at what happened in 2023, figure out, what happened, what did we learn from it, and then like where are we going as far as like just takeaways moving forward. So I think this is a great episode to kind of set the tone for, what happened, what can we learn from it, and let's look forward to 2024. Our next episode will, of course, have more predictions on kind of what we're expecting for next year.
Amazing. So where do you want to start? Do you want to start off with just doing a recap first, or do you want to start off talking about what's happening recently on the Solana DeFi ecosystem?
Let's start with just Solana. There was a huge airdrop recently, which we haven't covered this just yet, and it was a pretty big moment for Jito. So Jito Labs is building a Solana liquid staking solution, but they're also created a new Solana validator as well. So it's kind of this pretty interesting DeFi project within Solana. It's particularly interesting to me because I was really diving into Solana at the beginning of this year. And then around in May, I wrote a report really looking at the staking setup on Solana. At the time, we had the Ethereum Shapella upgrade, which allowed for liquid staking withdrawals. And so there was just a lot of discussion around this new business model of staking and kind of what that means for these various ecosystems. And I kind of went over and looked at Solana and said, okay, this is an interesting setup over here because over 70% of the SOL that was circulating had been currently locked in validators, right? So most of this circulating supply was actually in validators providing those services, but only like a little over 2% of it was in liquid staking solutions because Solana is a newer ecosystem. A lot of these new protocols are really nascent. So there just hadn't been a lot of like tokens added to these liquid staking solutions. So I started to look at that. I started to compare, okay, Ethereum was already at almost 30% of the circulating supply was in liquid staking solutions. So I'm like, okay, this is interesting. This gap is probably going to close. We wrote a report basically going through all the numbers of this and what we thought the setup was. And then we analyzed a solution, the largest solution, still is the largest solution on the market, Marinade Finance. We had a report go out where we kind of gave an update on what happened with Marinade Finance, which it basically went from a 10 million market cap all the way up to about 150 million. Recently, it's been kind of volatile, but I'm sort of revisiting that thesis. The thesis played out much faster than expected, but this Jito airdrop was a major catalyst for that to come about. And I think just super interesting to look at this Jito airdrop. So what they did was they dropped 10% of the supply. This is sort of their going public moment. So the project's been out in the wild for over a year now, gained some product market fit, and they dropped their 10% of the supply to the early users. And it came out at a pretty significant market value. It was over fully diluted. It was over $2 billion market value, which is a pretty frothy valuation. And a lot of people are looking at that. But what's really interesting to me is just the amount of wealth creation that occurred when they dropped this token at that $2 billion market value. There were over 10,000 people that received between $10,000 and $200,000 from this airdrop for being early users of the project. So I just think that's super interesting. Like, crypto rewards its early users in ways that I think are just still very underappreciated in the market. I think almost $300 million of wealth was created. And then that has sort of domino effect where you see either some people are selling some of those tokens, they're doing other things, maybe they're buying, we've seen some meme coins and things like that. We've sort of seen this wealth effect. I think this Jito airdrop definitely played a role. And, I've got some data here just to pull up to share and kind of look at Marinade versus Jito. We can kind of just go through this real quick. Yeah, I don't know if you have any reaction to just kind of this sort of what we've been seeing in Solana and this kind of liquid staking story here.
So look, I think it's a recycle of, in my humble opinion, what we experienced during the DeFi summer of late 2020 to 2021. I specifically remember a project called Wonderland on the Avalanche ecosystem that were giving out DeFi yields of 89,000% APY. And when they were giving that, a lot of people, early adopters, made money through it by staking their Wonderland tokens. And once they withdraw those tokens, they took their profit, which was crazy. 89,000%. Nobody can make that much of money. But people were, the initial adopters, they made money from it, just like a lot of, these high yield programs are like. The initial adopters always make money. So they made a lot of money, and then they recycled that money to other high yielding projects. I remember Olympus DAO was another one that was on the Avalanche blockchain that was providing, 2,000, 3,000% APY. So we saw a continuous recycling of wealth created money through these high yield DeFi programs on the Avalanche ecosystem. And then eventually, when the market decided that it's too good to be true, everything started dropping. Jito airdrop, of course, is very different. People have legitimately used it. And just like how Unstoppable Domains and Ethereum name service, they had their airdrop for early adopters as well. Like with ENS, people received ENS tokens, the ones that used ENS early, their service. So similarly, Jito users are getting the airdrop. So of course, this is different. But when it comes to the wealth creation effect, that people who suddenly got $200,000 worth of Jito tokens, and now they're recycling back to high-risky Solana projects, for me, that's like, just a replication of what we experienced in the 2021 cycle. But I'm excited to look at Marinade Finance. I'm always looking forward to more DeFi report analysis. Fan of DeFi report. People should check out DeFi Report Substack as well. Michael works very hard on that. So yeah, let's look at this analysis.
Let's take a look. Yeah. So yeah, and great points there. And maybe just to take a step back, like when we talk about liquid staking solutions, Marinade Finance and Jito. So what you had just referred to there with like Olympus DAO and some of these other protocols, very different. So when you're staking into Marinade or Jito, the only thing that you're staking is Solana. So you're participating in active validation of all the transactions on the network when you're using these protocols. You can certainly, there are other protocols where you can take the native token of the project, in this case, like for Marinade, that's the MNDE token, and you would stake that and provide liquidity, and like there's liquidity incentive programs. And I think that's what you're referring to with like Olympus DAO. That's very different from actually providing services, using your SOL token, sending it into Marinade Finance. They're sending that token to their distributed network of validators, and then you're getting a piece of the transaction fees plus, network issuance, the new supply that come, the consensus rewards that come into the market. So these are, pretty solid business models compared to Olympus from those other ones. But yeah, no, I just think this is pretty interesting. Like I said, we covered Marinade in May, and the project was really not very well known at the time, but they were the largest. They had the most value locked of any project within Solana and had a $10 million market cap. And I was looking at, seed stage projects that basically had just a slide deck that were raising at higher valuations than that. I thought it was an interesting opportunity. We wrote about it. And the Jito airdrop has really sparked this sort of awareness now of liquid staking within Solana. So I thought it was kind of interesting. Let's do a quick comparison here, Jito versus Marinade. And we can see that okay, Marinade is still the number one in terms of total value locked. So that's the SOL staked here. So they've got over 10.6 million SOL in the ecosystem. Jito has about 6.5. And then when you start to look at percentage of total SOL locked in the ecosystem, again, Marinade, pretty significant lead there in terms of the market shares. So these are the top two. We tend to see like power laws across public blockchains and protocols. We haven't really seen an instance where a first mover was really supplanted. And maybe that happens with Jito. We'll see. But so far, the numbers are still kind of on Marinade's side. These are the number of validators that come into, or that are a part of the network. So again, you stake your Solana into their interface, you connect your wallet to their interface, you send your Solana in there, they're just sending it to validators, and they have a ranking system based on the best performing validators. They're set, so that's a distributed network of validators underneath the protocol, and you could just see the difference in total number of validators there. In terms of like the total SOL stake rewards, Marinade has been around longer than Jito, but you can see that it's got, about 3 times the number of rewards to date. And then one of the just interesting things about Marinade was that the project came out of a hacker house within Solana. So there was no VCs. There's no VCs they actually bootstrapped the project with their own product market fit. They were able to pay their employees without raising capital, which is really interesting. So no VCs within Marinade. Jito does have a number of VCs. And then just in terms of kind of the way that the protocol works, in terms of like the smart contract, it's a custom code multi-sig for Marinade. Jito uses the Solana Labs smart contract. In terms of the validator selections, like I said, Marinade scores all of those validators underneath, and there's a ranking system, and the community can kind of vote on how that works. For Jito right now, they're basically permissioning in those validators and then selecting which ones get the stake that comes through their interface. In terms of like directed stake and the ability to actually just pick a validator and send it directly to the validator you want, Marinade gives you that opportunity versus Jito that doesn't just yet. And then just, like I said, Jito started a little bit earlier than Marinade. So Marinade's been around for over 2 years, over a year for Jito. So I just went through all of that. You would probably say like, okay, how's the market pricing these things? Marinade is dominating in almost every category. We look at the market values, Jito has like a 3x market value. So this was kind of the analysis. I thought Marinade was really underpriced back in May, and sort of the analysis we're going through now is to determine, is it still? Why is Jito getting priced at a fully diluted value of $2.3 billion versus $336 million? Right, for Marinade. So interesting analysis. That the report that's going out is really kind of going through this and trying to determine like is the market way off sides here, and kind of how's this going to shake out. But yeah, curious to get your thoughts on some of these numbers.
Yeah, so look, this is very interesting. I mean, we're the world's first crypto fundamentals podcast, educational, and this is exactly the sort of analysis that our students who watch it, our TradFi people who are curious about crypto watch it and wondering, how the hell do we value these protocols? So this is great analysis, first of all, Michael. So kudos to you and the DeFi report. And secondly, I'm curious, since you were so deep in analyzing all this, why is there so much of difference between the two protocols, when the statistics suggest that Marinade should be clearly valued more than Jito? Is it just the impact of venture capital money and market makers in the background controlling the prices?
Yeah, so I think that's essentially it. And this kind of gets to like, how crypto trades right now, and a lot of it's based on narratives and stuff. There's this idea. So Jito introduced this new validator client that allows, if you validate through Jito, this narrative in the market that Jito is basically Lido, which is the largest staking solution on Ethereum, plus Flashbots, which is another protocol on Ethereum that allows people to capture some of the MEV. So it's kind of like, okay, this is this new sexy thing in the market. So you have that narrative, and then you have large, well-known venture capitalists that backed this project. So when they bring the token to market and do the airdrop, they are pricing essentially what the market value is. Obviously the market is going to trade freely once it's out in the wild, but because it came in at, that 2 billion market cap or so, fully diluted, it actually rose after there was so much hype. It went to like almost doubled from there. It's come back since. I think that's it. Doesn't have these huge VCs that are essentially like on Twitter, like, almost acting as influencers. When they launched their token, they didn't have that type of setup. So I really just think it's a narrative. It's not, this is why we do the analysis, right? To determine what do the fundamentals say versus the narrative in the market. And if nobody does this analysis, then that narrative can just persist and nobody even knows what's going on. So that's part of why we're doing this. Let's get this in the market. Let's let people decide that do these valuations make sense. But yeah, that's kind of the thinking there.
Sure. So Michael, I'm just curious. So Jito has got like a valuation, significant higher valuation, especially when you look at the fully diluted market cap. Is there anything that Jito does better or different than Marinade? that warrants that higher valuation?
That's really the exercise that I've been really going through. And I can't really see it, to be honest. That it's really, this is the narrative around Jito offering not only the staking rewards if you stake your soul with them, but they actually capture some of the MEV and then that gets shared with the delegated stakers. And I think that's sort of the perception of the market, that Jito offers that and Marinade doesn't. But actually Marinade stakes some of they're a staking pool, and they actually use Jito's validator client, which allows for that. So Marinade actually offers this to their stakers as well. So I don't see that as like, actually, I think it's a narrative that's untethered to like the truth of how these things work. And, you know, in terms of the business models, so the way that these projects make money is the users are depositing, you know, Solana into their validator clients, and then they're returning you the yield that comes from that, which is the fees that people are paying on Solana, plus the consensus rewards, plus the MEV. And then for providing that service, they just take a small percentage. And I believe Jito is taking 5% and Marinade is taking 6%. So there's one like kind of small difference there. But besides that, I mean, the business models are pretty much the same. You know, you're dealing with different teams, right? So there's different smart contract risk and things like that could potentially get priced in. But I don't see that as really the mover of what's driving these valuations. I really think it's a narrative in the market and kind of the VC presence, I think. We'll see. Like I said, this report went out to readers of the DeFi report, and the market can kind of decide, you know, how this plays out going forward.
Cool. Sounds good. Great analysis. Thanks for sharing this with us, Michael. Moving on to what's happening with conquerors of global capitalism, the Federal Reserve Bank. What are they doing these days now, Michael?
Yeah, you know, I just thought it'd be good just to touch on this real quick. So the Fed had a meeting, you know, we haven't discussed this on the pod just yet, but pretty dovish meeting in the markets. Even the traditional markets have rallied off of that. We've seen the bond market start to really kind of project out like lower interest rates. So we're seeing a huge drop in the 10-year yield. I'm actually just going to share. Yeah. So, you know, I think this has just been interesting to see after Jerome Powell had his press conference, went in front and basically said they're planning on dropping interest rates into 2024. And so now the market is starting to price this new information. So yeah, we're seeing now the market essentially repricing bonds after Jerome Powell's meeting. You know, we can see that almost at 5% on the 10-year, and it's already down below 4%. So a pretty big move in a pretty short period of time. We've seen S&P 500 and NASDAQ rallying of late. I just think this is pretty interesting. We've been talking about this for a while. The DeFi report, anybody who's been reading our reports, we wrote a report a few months back, just kind of the setup for the next cycle. And this is really what we've been expecting to see, is that the Fed is going to be unable to maintain rates where they're at. And there's going to be this pressure to ease and have this more dovish monetary policy, which looks like it's going to line up with the halving event, you know, Bitcoin ETF and these types of things, which is pretty interesting. One thing that I think is interesting related to this, I'll just pull this up real quick. This is the bank term funding program from the banking crisis last March. This chart that we're looking at these are banks that are accessing emergency loans because of the value of the treasuries on their balance sheets. And they're worried that depositors are going to come get their money out of the bank and they're not going to have enough reserves in the bank. And so interesting to see this spiking up. This is kind of where we started. It's almost doubled over the last year quietly. No, everybody stopped talking about this after April, May, but it's doubled. To me, this is probably playing into what the Fed is looking at and saying, okay, this liquidity is really drying up out there. There's some stress in the market. So I'm sort of expecting there to be some sort of volatility, and then the Fed will pivot. And I think the market is a little bit offside. It's because the market hears, oh, dovish, go buy risk assets, go buy stocks. But actually, when they start to reduce rates is usually when there's big sell-offs happening in the market. So I'm kind of like expecting to see some volatility here at some point. I think the crypto markets are sort of leading traditional finance markets. I thought it was interesting that after the Powell speech, crypto didn't really rally, but the traditional markets did. The traditional markets already had our rally. We'll see going forward. I could be wrong about all this. I just think it's kind of interesting to see this chart. And then what Powell's saying, we kind of predicted that this is kind of the setup, but I would expect some volatility moving forward as well. Any thoughts there?
Yeah, look, I'll tell you what, this year has been such a goddamn crazy year. We started with Bitcoin at $16,000, and all the people who thought that, you know, we told you so, they all got shunned. Bitcoin is now at $41,000. Same thing with Ethereum. We started the year at around $1,100, even less than what it was in the 2017 peak cycle. It's now at $2,100, still 50% less than its peak of 2021, but still it's above $2,000. And when we look at the stock markets, especially if we are talking about the US stock markets, it's now, nowhere near what people expected during the start of the year, that it will continue to correct. People thought that S&P 500 will go to 3,000 levels and touch 2,900 maybe. Nowhere near that. NASDAQ is again back to not its peak, but still it's relatively high than what people expected it to be. When we look at global market index, Germany stock index is at an all-time high. India's stock market is at an all-time high. So everybody who thought that because of the increase in US interest rates, we're going to see massive downfall in valuation of emerging asset class or risky asset class, they all have been proved to be wrong as we're approaching the end of the year now. So it's a crazy year. And look, this is interesting, this graph. I've actually been tracking this ever since the Silicon Valley Bank debacle happened, because this rise, the spike that you're talking about, it coincided with the Silicon Valley Bank bankruptcy that happened and the bank run that happened. So
yes, this was created because of that. This chart didn't even exist before that. This is a new program. Yep.
Exactly. So, I've got my own take where we can do a separate episode about it, but the global financial system is super fragile, where the increased interest rate, banks' risk management can't take care of it. So the Federal Reserve Bank creates a new system to provide liquidity that for the general population, they would not understand, but it's another form of QE effectively, for the banks. So it's such a fragile system. And it's very hard to navigate the markets. Only time will tell. There are people out there who are still saying that we're going to enter recession. And when I mean we are going to enter recession, US is going to enter a recession. But when we look at the job market, it's still very strong. People are still buying stuff. But at the same time, when you look at the delinquency rates, those are high. So it's just a crazy year. That's what I can say. This year has been a crazy year.
I agree. I think the economy's been pretty resilient to all of these rate hikes. And I just think it takes time. I think we talked about this in prior episodes. It does take time for this to kind of get baked in. And in the US, at least, the government has been spending a ton of money to sort of support, I think, a lot of the job in the labor market. So we'll see. Starts to shake out. But interesting to see a total change in course, I think, from Powell's speech recently. But why don't we move on? 2023. These were sort of the topical things we wanted to talk about this week, but let's do a full recap of the highlights for 2023, what we learned, and kind of takeaways moving forward.
Let's start out from what our friends at FTX did last year in November and all the crash that started, because of which we started this year with $16,000, $17,000 Bitcoin price levels. So it's crazy that we saw FTX, justice getting prevailed. The dudes are in, where they should be because of what they did for the crypto market, and crypto market has rised up. But I can see that you've got some good analysis for us when it comes to distressed crypto assets. So why don't we talk about that first, Michael?
Yeah, so I think we started the year, just kind of going back to the beginning of the year, was still dealing with the fallout from the FTX debacle. I think Sam Bankman-Fried was arrested just at the end, sometime in December. The markets were basically bottoming out. You had all this FUD in the market around Solana. And we talk about fundamentals a lot on this podcast. And what I find, and we'll probably talk about this more as we go into the next cycle here, but fundamentals really matter at the bottom of the bear market. That's actually when it's most useful to be looking at this. And we shared a report, this was in December of last year, where we were basically looking at what we were calling distressed crypto assets, where we were simply looking at projects that had 365-day revenues that exceeded their market caps. And it's kind of a one way to think about, when you look at book value of a company and where it's trading at in the market, that's one way to do a really simple fundamental analysis of an equity. And we were sort of just taking a similar framework and applying it. It's not necessarily book value. These are revenues. It's not looking at the assets of the protocol, but it's one way to do a similar type of analysis. And so, we started the year in a pretty rough shape, but I think if you go back and look at a lot of these projects, these were not necessarily projects we were saying, hey, go buy the token. We were just saying, hey, look at this. This is one way we can do the analysis. And a lot of these are up orders of magnitude because of kind of once the liquidity returned to the markets, these things get repriced pretty quickly. So I just wanted to kind of bring that up in terms of, we talk about fundamentals a lot. The year started with, I would say probably one of the best opportunities to invest in crypto was this past December. This always happens when there is a lot of fear, uncertainty, and doubt in the market, right? So it has to be when FTX is blowing up or there's leverage being wiped out of the system in some way. That's always the best time to be buying. If you have that conviction, like Warren Buffett always says, when others are fearful, be greedy, and when others are greedy, be fearful. And so I think that was the takeaway for me at the beginning of it.
So good on that. So do you think, will it happen again?
I think it will. I expect, I think there's a lot of people that think eventually Bitcoin and the crypto markets will mature and we'll see much less volatility, and then it'll just be like traditional assets to own in a portfolio. I think we're pretty far away from that. And so the markets are going to keep getting much bigger, I expect, but I think we'll still have the volatility. So yes, I do expect another bull market at some point, and then we've typically seen like 80% drawdowns off of that. That is getting tampered a little bit, but you could go, I don't know, Bitcoin could go orders of magnitude higher than it is today, and it drops 80%, and you're still dropping to, let's call it, 50 grand or something per Bitcoin. You keep resetting, and every time you drop to a new low, it's higher than the last low. So you would have, the last low was around 15, 16,000. So the next one, the low before that was like 3,800. The one before that was, in the hundreds of dollars. So it just kind of keeps doing these stair steps with obviously lots of volatility mixed in there. So I do expect more volatility. How about yourself?
Yeah, look, I remember specifically when I got into crypto back in 2016, 2017. And initially in the TradFi company that I used to work for, people used to think that they are super intelligent and I am a degen, because they used to believe what Jamie Dimon used to say. And that's what they used to paraphrase and said that, we'll never get into it. And then when they saw in December 2017 things peaking out, they were saying that, oh, you got lucky. I wish we got onto the boat, but we are late. And I told them, you're not late. You got no idea. Like we spoke during our first episode, we are only in the first innings of a 9-inning baseball game. And people just didn't have that foresight. Come 2020, 2021, when they had the chance again to buy something, they said no, because I told you so. When the price rose up, the same people said they lost the boat. So I also believe this cycle will continue for foreseeable future. Financial crashes, whether it's in crypto, whether it's in commodities, whether it's in equities, it's human nature. It keeps on happening. So we're going to see this happen again. And we're going to see the same type of people saying that, told you so, it's going to go down. And then when it goes back up, oh, we missed the boat. You got lucky. But anyways, those are the sentimental analysis. What I'm really looking forward to is the Operation Choke Point. What is Operation Choke Point, Michael?
Operation Choke Point was, I guess, the thing we saw after sort of the markets crashed and we saw, a lot of leverage get wiped out of the system. We saw, obviously, frauds being revealed. And the next shoe to drop was this idea. And Nick Carter was really leading the charge. And I recommend people check out a lot of the writing he did on this subject. But this Operation Choke Point 2.0, it's 2.0 because, and this was the government's term for this, Operation Choke Point. The first one happened in 2013 under the Obama administration, and that was unrelated to cryptos. There was just another instance of essentially what Operation Choke Point was: regulatory agencies sort of overstepping their power a little bit and using the banking system to do so. So essentially going after industries that maybe were unfavored. So Operation Choke Point 1.0 was going after dating websites and firearms manufacturers, payday lending companies, cigar manufacturers was another one. So, maybe unfavored industries, but in America, the government doesn't really make decisions on like what can be an industry. It's more just how do we regulate that industry? If there's just a demand for those services, they typically don't have an opinion about that. It's just how do we regulate and protect consuming public? What we saw there was like something a little bit different. And so we saw this same thing come to crypto. And that's really what Nick Carter was calling out, was Operation 2.0. We had this flurry of actions taken against crypto companies. I'm going to read a few of them here, but you had on January 9th, you had Metropolitan Commercial Bank announced total shutdown of their crypto services. On January 27th, the Fed denied Custodia Bank's 2-year application to be a member of the Federal Reserve System and essentially gave no explanation as to why. It was supposed to be a 100% backed crypto bank. This is exactly what crypto needs, and it would allow for fiat to stablecoin settlement. So that got rejected in January. On January 27th, the Fed issued a policy statement discouraging banks from holding crypto assets or stablecoins, broadening their authority over non-FDIC insured state chartered banks. We had Kraken, was fined $30 million. This was early February. And then on February 12th, the SEC announced a lawsuit against a pretty well-respected infrastructure company called Paxos, which has sought regulation from the very beginning. This is a stablecoin issuer, Paxos. So they were targeted by the SEC. Later in February, Gary Gensler, this is when there was a lot of jawboning coming from the SEC about every crypto asset is a security except for Bitcoin. So we kept hearing that over and over and over again. Later in March, the Attorney General alleged that is a security. And then the White House released this economic report later on in March. And this is where they just called out crypto for basically providing no utility to the world. And it was kind of amazing to me because the section before the crypto section actually went into the problems with the web and how users can't control data and can't have privacy of data and things like this. And then they went into crypto. This is one of the primary value propositions of crypto, and it wasn't even brought up in the crypto section. So there's just a lot that happened, kind of a barrage. Some of these things are legitimate. I think the industry certainly needs to be cleaned up, and bad actors absolutely need to be held to account. But it just seemed like this was somewhat of a coordinated effort. And then, of course, we saw the Coinbase received a well notice and was eventually sued by the SEC. So just a lot happened at once. What we're now starting to see, or if we kind of start to move forward to the beginning part, the middle part of the year, is some of these things going to court cases. So I'll pause there to get your reaction, but we can talk a little bit about just what happened with the original choke point and what I sort of expect to see with the crypto 2.0 version.
Yeah. What happened this year, again, I know I'm repeating myself, was crazy, but it's just incredible that how I think all of what we experienced this year, especially when it comes to crypto, was a lot to do with the FTX fallouts. I think when we look at the genesis of whatever happened this year, we all come back to what happened with FTX and the shock that the whole TradFi system, the regulators, and the crypto ecosystem went through. And, the regulators, including people at the White House as well, they just thought that we need to shut everything down. So yeah, it was an overreaction. I don't have any intel, but it seemed like a lot of insider stuff happening as well that is purposefully making the industry look bad and punishing good actors like Coinbase as well. I mean, for God's sake, Coinbase got IPO'd. The process of getting IPO'd in an American stock exchange is not the same as getting IPO'd in an emerging economy or China or other countries. It's very rigorous to get IPO'd in either the NYSE exchange or the NASDAQ. And they got IPO'd with flying colors, and then you're finding them. It just was a circus, if you ask me. And yeah, it's good to see that TradFi players are coming in now. So whether it is because to choke the original crypto native companies to make way for BlackRocks to come in, conspiracy theorist dream would be to say, yes, it is, because it seems like that way. But for other people, it could also be that it was just an overreaction of the FTX fallout. TradFi people are noticing maturity within the industry with all the bad actors one by one getting punished. So now they see that they have built the infrastructure and they see that the market is wanting TradFi people who got the trust in the market to come and take crypto forward. But it's so ironic, right? The whole point of starting crypto was so that we get out of the legacy Wall Street machinery, and it seems like Wall Street machinery is now paving the way for crypto because the crypto natives rejected the purity of the Bitcoin white paper and created a degen casino gambling industry. So it's ironic what has happened. I would love to get Roger Ver from the Caribbean islands to come on the show and get his view, not about the Bitcoin Cash and Bitcoin, but on what he thinks the crypto industry has turned into now from what it was originally supposed to be back in 2013 and 2014. But yeah, keen to get your take now on the future.
Yeah, I mean, it's a good point. I don't necessarily think, I think the people in crypto like to point at conspiracy theories and things like this. I don't necessarily believe in that. I just think, I think you used the word, maybe they overstepped or there's just, there probably was some sort of coordinated effort to sort of contain things and maybe there's an abuse of power that comes with that. But I think that's probably the biggest takeaway for me is going back and looking at just what happened in the first one. I spent a lot of time on this, and I'm going to share my screen because I wrote about this and I wanted to share it with people here. So this was in an article I wrote earlier this year on regulation, and these are some quotes from this is the original Operation Choke Point, where this had nothing to do with crypto. It was the FDIC sort of going after unwanted industries and using the banking system, right, to do that. If you shut off someone's access to their bank accounts, you essentially kill a company. And so these are direct quotes at the time. So this is the former chairman of the FDIC, 2014. Scathing opinion piece in the Wall Street Journal. He wrote, "Don't like an industry? Send a message to its bankers." Here's another one from Sean Duffy, House Financial Services Subcommittee Chair, 2015. "I feel that activists at the Department of Justice and the FDIC are abusing their power and authority and are going after legal businesses. In fact, they're weaponizing government to meet their ideological beliefs." Again, kind of just overstepping. This is Frank Keating from the American Bankers Association. Operation Choke Point was asking banks to identify customers who were simply doing something government officials don't like. Banks then choke off those customers' access to financial services, shutting down their accounts. We saw Silicon Valley, at the same time that Silicon Valley Bank went down, Signature Bank was essentially seized by the government. And it's really important to understand how important Silicon Valley Bank was to crypto, because Silicon Valley Bank was the only bank remaining that had this stablecoin to fiat liquidity network that all the exchanges were using. Right, this is really like really foundational infrastructure supporting liquidity of the crypto markets, and there's still a lot that has not come out about this Signature Bank seizure. But like, these are some quotes. This is from Barney Frank, who wrote legislation related to the 2008 financial collapse, and he's on their board. "We're not a big high-tech lender. We're a big New York City housing lender more than anything else. We weren't having crypto as our own asset. We were simply allowing two businesses that were customer of ours that wanted to deal with each other in crypto to do so. We were a facilitator. The regulators wanted to send a very strong anti-crypto message." And, I recommend people check this out. It kind of goes through the story of the FDIC actually they conceded that the bank was not insolvent when they seized it. This has never happened in the history of banking, that a bank was just basically seized like that by the government. So anyways, like to point to conspiracy theories or anything, but there was certainly some stuff happening here that was questionable at the least. And as the year progressed, we got to see some court cases come out. And this is what I think, as far as the takeaways for me, when you go back to the first Operation Choke Point, what ended up happening was court system came down very hard, the FDIC, for overstepping our boundaries. And I expect the same thing to happen here with crypto. And so far, we're seeing signs that the courts are actually staying out of politics. And the signs of that there's been 3 court cases so far this year that I think that are pretty interesting. So the first one was, can't remember, maybe you remember the order of these, but you had the Grayscale Trust. So the first one was the SEC's denial of Grayscale's ability to convert their trust to an ETF. The courts basically said that what the SEC is saying there is just not legitimate. We've had a futures ETF that's been approved to the markets. There's no reason why there isn't a spot ETF. And I think they used some pretty aggressive legal language to describe what the SEC was doing there. And now we're seeing basically Gary Gensler concede that, okay, the courts have a different take on this. And now we have to figure out Bitcoin ETF, that's why we're seeing all this bullishness around a Bitcoin ETF. That was the first sign that the courts were coming down right down the middle on this. And then the second one was Uniswap case, where a user had lost a bunch of money because they bought scam tokens using Uniswap, and they sued Uniswap and they sued the investors behind Uniswap, and the court threw that case out and basically said, they were comparing it to any other technology platform out there, and that the technology platform is neutral. They're
decentralized.
They're decentralized. Exactly. That was kind of it seemed like the court really understood that. And so that was a big one. And then we saw the Ripple case. So the Ripple case was around whether or not XRP is a security. Court said it was not. And so that just sort of breaks down a lot of the momentum that seemed to be established from Gary Gensler saying everything's a security. He went in front of Congress and he wouldn't answer the question whether Ether was a security. And so, we started to see this all of a sudden, there started to be a little bit more momentum behind crypto. And this is kind of in the middle of the year. And this is what I expect. I think it makes me proud that the court system in the US seems to be coming down the middle on this and just dealing with the facts. That's great to see.
Totally agreed. I mean, that's the great thing about the US, right? The separation of powers. It's truly separate. The central bank is truly separate from the government. Unlike, and I don't mind going out in public, unlike Turkey, where somebody who runs the government is dictating how they should run the central bank as well. Ever since the person has been in power, he's been firing central bank governors after every few months because he thinks he knows more about economics than the central bank governors. And same thing happens in countries where there is no separation of power between the government and the justice system. So I think that's always been the powerful thing about the US, the separation of powers between the different infrastructures and between the different authorities. And yeah, one should be proud about that system. Okay, Michael, like this was a lot about the US authorities and all. Let's go back to crypto a little bit and talk about the big daddy of smart contracts, which is Ethereum. Shapella upgrade, staking withdrawals. Market was worried about it, that there's going to be mass exodus. Tell me about it. What actually happened this year with the Shapella upgrade?
This was a pretty big moment. This was kind of in the middle of the year as well. Back in April, Ethereum had their upgrade, which allowed for ETH staking withdrawals. So pretty big moment. And I think the market was worried that people that had put a lot of their stake into these Ethereum smart contracts was going to just withdraw them. And that could cause some hurt the security of the network potentially if a lot of people withdrew all their ETH at once. And the system is set up so that there's a queue so that that really can't happen. And you have to sort of wait in line to do so. But actually, like the exact opposite happened. So this is kind of where the technical upgrade occurred here in April. And we can see that the amount of ETH that was staked within Ethereum at the time was 18 million ETH. And now just less than, a year later, we're almost double that. We're up to almost 35 million ETH now within Ethereum smart contracts. So pretty interesting. Most of the other networks out there, when you look at Solana, when you look at Avalanche, these other like kind of alternative L1s that launched after Ethereum, they have much higher stake rates. So they're typically in the 60 to 70% of the circulating supply is locked in staking. For Ethereum, this is getting close to 30% now. It was about 15% before it had this upgrade. I expect this to even go larger, even get closer, maybe up to 50% or something in the next year or two. This was a big moment. This allows Ethereum to become like this yield generating asset. We think this is pretty important for like Wall Street. If Ethereum gets an ETF, like that ETF is likely going to return a yield to people that purchase the ETF. And it also sets up an interesting potential yield curve for DeFi where you have this stake rate, and this stake rate's being standardized now. There's something called Caesar that CoinDesk has released in conjunction with CoinFund to standardize the ETH stake rate. And then we're going to start to see innovations coming around this, that you can start to get like a fixed yield off of Ethereum. You can start to build off a yield curve for DeFi. So it's a huge moment. I think most people were focused on just like potential withdrawals of ETH, but it's actually a much bigger moment in terms of like building out DeFi and standardizing yields in the ecosystem. So I'll pause there to get your thoughts.
Yeah, look, this is something that I'm monitoring actively as well. And Ethereum is central to the whole DeFi ecosystem. It's great to see what's happening in Solana. It's great to see what's happening with Cosmos, with Avalanche ecosystem and all that. But they all are piggybacking the success of what would happen with the Ethereum DeFi infrastructure. So what happens on the Ethereum network with its staking is also supremely important, like you alluded, with the whole DeFi ecosystem as well. And there are so many more upgrades that are yet to happen with Ethereum as well. So it's something that, as we're going to start the new year 2024, that we'll be actively monitoring as well. Technology is going to play a role. Regulation is going to play a role. Token incentives are going to play a role. So really looking forward to it. And this is a good chart to kind of like showcase that as well. So Michael, I think we're ready to go on chain now, is it? See what the year has ended by going on chain with Token Terminal.
I'll see you in the terminal. All right, here we are. Yeah, so just to kind of cap off, I guess, the 2023 and kind of like we talked about, just sort of we started the year on a pretty bumpy road, got into a lot of things that were happening with regulators, some positive stuff in the courts. And then as we got towards the end of the year, we just started seeing more really positive things happening, not just on chain, but like in the news and Bitcoin ETF. One of the cool projects that we started to see pop up towards the end of the year, really September was when this started to take off, was this new social media app called friend.tech. And so I've got some data pulled up here. Just looking at friend.tech, we're looking at active users, daily active users versus fees on the network, and you can see this has dropped off significantly. We can't say that this is like a product market fit just yet, but what I would look for here potentially is an airdrop from friend.tech at some point, because they don't have a token just yet. And then what I would expect to see is this user activity come up again. Now, to determine if they really have product market fit, that is when you need to see the sustained usage of the network after those incentives go away. And I haven't used friend.tech myself just yet. I don't think you have either, Shiv, but we can see like there was a point here where they got up to, 21,000 active users, 2 million in fees. So, still a pretty small thing, and just kind of like trying to find some traction with crypto natives. But there's something here. I think that there's going to be a big project come out of crypto that's a social media app at some point. We haven't really seen the perfect fit just yet. But I'm expecting, and I don't know if it's going to be friend.tech or if it's something out, but I know there's lots of people working on something area, and I just think that it's going to hit at some point. So I'm expecting in the future we see a very popular consumer app that's like combining social media plus sort of this, I don't want to call it gambling, but like you sort of have this financial element that gets introduced to it. And I think the way I look at it is that's just what gets engagement. Like, I think a lot of people are just think that crypto is going to financialize everything. It's the consumers that decide. And if that's popular for people to use, and there's a reason that games are very popular, something like this is going to hit at some point, I believe.
Yeah, so look, I totally agree with you. So I had a few venture capitalists out of US and out of Australia on the Proof of Work podcast, and we spoke about Friend Tech, and one of them episode is also live under the Rising Venture Capitalist in Crypto, Danny Pentuso from Decasonic, based out of Chicago. So I had him on the podcast, and I asked him that, what is the most underrated Web3 project according to you? And he told me that he thinks FriendTech is underrated. So I also agree with you. And he also said, and he's in the Web3 venture capital game, he said on the podcast that he thinks that FriendTech has paved the way, that future of social media or future of social networking is going to be built using token incentives and crypto networks. FriendTech has showcased that. And he said that if FriendTech would have been in his portfolio, he would have been proud of it. That's a statement that a lot of other venture capitalists based out of the US have also shared with me. So I also agree with your assessment there, Michael, that I think something is there to be learned for Web3 product managers and entrepreneurs, that they can learn from it, build something out of it. Of course, I actually went on record within that same episode and said that this is going to be a short-lived hype. But yes, I do agree that there is something to be learned out there, because the spike that it witnessed was very organic and community-driven. Something very similar that we saw during the origin days of Facebook.
Yeah, definitely something here. So we'll keep an eye on this use case. We'll keep an eye on FriendTech in particular as well. But yeah, moving on to sort of other interesting stuff that was kind of happening year end. So pulling up Bitcoin here again, we talked about Bitcoin prior episode. The Ordinals protocol, once again, is driving a ton of fees to the network. We saw this really popped up, and this was one of the things kind of mid-year. This is one of the positive developments that we saw mid-year was Ordinals. And then it kind of just, it was sort of a short-lived little thing for a minute here. We're looking at Bitcoin's transaction fees, and these spikes are really coming from ordinals. And so we saw it trail off, but now we're back. So good sign. When you see something sort of get like a hype moment at the very early stages, which we see often in crypto, that hype can fade pretty quickly. There's always another shiny object that comes out and captures people's attention. But what you want to see is like a developer community form, and to get real infrastructure around there, and actually over time, like more users come in and you see like something like this. So I'm starting to develop conviction that Ordinals is for real. And, is it just going to be like these inscriptions that we're seeing in the early days? Probably not. There's probably more to come here, but there seems to be something real happening here. And if people are interested, once again, like I wrote an article in the DeFi report, people check out the archive, they can find this report. I think it was called Bitcoin's Going Under a Paradigm Shift, because we were thinking about what are these new use cases. Bitcoin might not just be a payment network and digital gold. It actually could be more things. And because these are open, permissionless systems, that's what we should expect, right? We should expect a global hive mind of developers to build interesting things on these networks. Similar to the internet. The internet is endlessly innovative because it's permissionless and it's open, and anybody can spin up a website or build something. So super interesting. I expect to see more interesting stuff coming out of Bitcoin. But yeah, curious your thoughts on ordinals and just innovation, I guess, on Bitcoin in general.
Yeah, I think we covered that on my favorite episode of the Rundown, which was the end of year 2023 Bitcoin health check. So I think we covered that a lot over there. For people, do check out that prior episode on our socials. We covered ordinals in detail there. But let's look at the trending smart contracts that we've witnessed this past year, Michael.
Yeah. So, we've talked a lot about L2s. Again, this is just, coming into year end, we're seeing an uptick in the percentage of gas fees coming from the L2s within Ethereum. And what we're looking at here is trending contracts within Token Terminal. And what I've done is just, this is all sorted by Ethereum. And we're just looking at the top contracts that are driving the most gas fees. And this is just over the last 30 days. We've talked about this in our Uniswap episode as well. Uniswap drives the most fees to the network. But if you start to come down, you can see, okay, here's the first L2. So we've got an L2 now in the top 10 in terms of driving gas fees to Ethereum. And then you start to come down a list a little bit longer, and there's the second one, ZK Sync Era, that's an L2. And you kind of scroll down, you can see, oh, here's another one, Starknet. Here's another one that's in the top 15 or so. And then we get down to the top 20, and you've got Coinbase and Optimism. You've got 5 L2s in the top 20 in terms of gas consumption on Ethereum over the last 30 days. And so this is just something, we've talked a lot about it. We're watching this pretty closely in terms of, applications are going to start continuing to build more on L2. And then obviously that has an impact on economics, margins between L2 versus Ethereum L1. Encourage people to check out our episode on L2s for more details on this. But in terms of just things that happened towards the end of the year, this is something that we're keeping an eye on. It's a positive development for the Ethereum ecosystem and something we'll keep everybody updated on, moving into next year.
This is an amazing feature of Token Terminal, first of all, and thank you for bringing that into light. What I've been amazed, it's only after seeing this, is that this year has definitely been not the year for NFTs. When I'm looking at OpenSea fees being less than $4.5 million. I mean, OpenSea was generating. Is it possible, and I'm putting you on the spot, but is it possible to open OpenSea chart?
We can go to OpenSea if you'd like. So let's...
Just quickly, I just want to see its comparison of fees since inception, because I did not expect that they would generate only $4 million fees, and that's for the year to date, right?
All right, so we're looking at OpenSea here, Shiv, and to your point, there was a massive bull run in NFTs. This was sort of the end of the last cycle. So toward the end of 2021 is when OpenSea we saw fees just going nuts. These are the actual fees on the OpenSea platform, which is different from what we were just showing. We were showing gas consumption. So user comes through the OpenSea interface, they buy an NFT, they're paying a fee to OpenSea to buy that because they're the platform, they're providing the marketplace. They're also paying a fee in the gas. And that's what we were looking at a minute ago. Now we're looking at the fees that OpenSea captures. And these are the royalties and transaction fees paid by collectors. So obviously, this has been a massive drop. So it'll be interesting to see if this comes back. But huge drop here.
Yeah. So I think in the new year, 2024, we'll probably do an episode on NFT protocols as well, where we'll include, some analysis for Immutable X being one of the NFT protocols and other Web3 gaming protocols as well. Because, that's what I found interesting, because I remember looking at OpenSea during 2021 and even in 2022 that, my God, they were generating a lot of fees. And because NFT transaction requires a lot of gas, I was expecting that the proportion of gas fees on the OpenSea contracts would be way above $4 million. So that's why when you showed me the trending contract and I see OpenSea right at the bottom within the top 20 section at $4 million, I was just amazed because I was totally not sure that it's going to be so less.
It's up there. I mean, it's not like it's, there's thousands of these contracts in here. It's in the top 25, but yeah, it's not in the top 10. We'll see if it comes back. But interesting to your point, this is Blur. Blur is a competitor. This is a competitor that popped up later on in the cycle, really during the bear market. Blur came in and they're doing better than OpenSea, at least in terms of driving gas consumption to Ethereum right now. So keep an eye on this. I think the NFT markets are starting to come back a little bit, but keep people updated. And I think it'd be great to do a full episode on-chain activity with NFTs.
Amazing. So what's next? Are we looking at Solana?
Let's look at Solana. This is kind of just wrapping up here. So we've talked about just sort of, we're now in like the end of the 2023. Things have been looking good. Solana has been a leader in a lot of this. We've seen the Solana ecosystem come alive again. We talked about that with DeFi. And what we're looking at here is Solana price to the active users. And we've talked about reflexivity in crypto. And this is like another way to look at it. We've looked at the price relation to like fees. So price versus on-chain activity. This is a similar way to look at that analysis. active users. These are wallets that are interacting with the Solana protocol. And so, again, you've got the purple line as the price and the green line is active users. It's just fascinating to me how when the price rises, more people come into the ecosystem. There's an interesting relationship here where as soon as Solana gets in the news, people start talking about it. It's on CNBC and it just drives people to come on chain. And then DeFi starts to pick up, total value lock rises, and you see this reflexive nature continue to get priced into the network. And so Solana's looking good. We'll see where things go from here, but sort of drawn a lot of attention away from Ethereum in the short run. I think actually we'll see that sort of ricochet back to Ethereum at some point, but it's been interesting to see Solana sort of in the limelight here for the last few months.
So I believe that is our wrap up for the going on chain with token terminal for this year, at least, Michael, I think. Wouldn't it be fair to say?
I think so. That's all we've got for this week. I mean, as far as like heading into next year, we're going to do a full episode on that. We thought it was helpful to kind of look back at the past year, get into what happened, what can we learn from it, and like, what does it mean going forward? But yeah, I think next week we've got a pretty exciting episode where we're going to actually do our full on predictions, and then we'll have to come back to them. This is part of why I do a lot of writing, is to hold myself accountable. So this is just another example of us holding ourselves accountable. We'll have some predictions and we'll revisit them at some point during the year and see if we were right about any of it.
Of course. So look, like all times, everyone, please share your comments with us. Tell us where we are good at and say thank you if you love it. If you don't like it, tell us why you don't like it so that we can improve upon it. I know Michael works really hard for these podcasts. He does so much of analysis. He brings so much of value. So please do share with us what you like, what you don't like, so that we keep on improving. And otherwise, wish all of you a fantastic end of your holidays, fantastic New Year. Celebrate with your family, with your friends, with your loved ones. Make New Year resolutions so that you start the new year 2024. And Michael and I will be back during the first week of 2024 with some 2024 predictions. So yeah, thanks a lot for watching. Michael, any last notes for our viewers as we are approaching end of the year 2023?
Just super excited to go into the new year. I feel like it's going to be a good one for our industry. We're excited to keep doing these episodes on a weekly basis. And yeah, Happy New Year's to everybody. And we'll see you in 2024.
All right. See you, Michael, also in 2024.